Index funds, mutual funds, hedge funds, and ETFs. You've probably heard these terms before. In this video, I'm going to break them down in a simple and practical way. First, we'll understand what a fund actually is. Then we'll look at the different types, how they're managed, the risks involved, the fees you may have to pay, and the strategies they use, and most importantly, who they're really designed for. So give me just 10 minutes and I'll share knowledge that usually takes years to learn. But before we begin, I want to be clear. This is not financial advice. So what exactly is a fund? Before diving into the different types, let's start with the basics. Imagine you and your friends are planning a birthday party. Instead of one person paying for everything, everyone contributes a small amount. With that combined money, you can afford food, drinks, decorations, a cake, and even music. No one has to carry the full cost, and everyone enjoys the event without the stress of managing everything alone. That's essentially how a fund works. A group of people pool their money, and it's invested into different assets like stocks, real estate, or bonds. Instead of handling every investment yourself, the fund manages it for you, and you share in the results. Now that you understand what a fund is, let's explore the different types. We'll start with index funds, which are very popular, especially on social media. You've probably heard people say, just invest in an index fund and forget about it. But what does that really mean? An index fund is a type of fund that doesn't try to pick winning stocks. Instead, it simply follows a list or index of companies. But what is an index? Think of it as a benchmark or a sample of the market. It's a list designed to represent a specific part of the market. For example, the S&P 500 tracks 500 of the largest and most established companies in the U.S. Larger companies have more influence on the index. When the S&P 500 goes up, it usually means the overall market is doing well. There are many different indexes. Some focus on technology companies like the NASDAQ. It includes major companies like Apple, Microsoft, and Amazon. It has grown significantly over the past decade due to the rise of technology. Others focus on industrial companies like the Dow Jones Industrial Average. This index tracks 30 large companies across various industries. Companies like Coca-Cola, Boeing, and Johnson & Johnson are included. There are also indexes for small businesses, international markets, emerging economies, and specific sectors like healthcare or energy. So the idea is simple. No guessing, no stock picking. Index funds are passively managed, meaning no one is actively choosing investments. They simply follow the index, which helps keep costs very low. You're not paying for a manager, just the system itself. Most index funds charge a small annual fee called an expense ratio, usually between 0.02% and 0.20%. So if you invest $1,000, you might pay anywhere from 20 cents to $2 per year. That's incredibly low. Companies like Vanguard, BlackRock, iShares, and Fidelity are well known for offering these funds. Index funds are considered relatively low risk because your money is spread across many companies. If one company performs poorly, it usually won't significantly impact your overall investment. Before moving on, there's something important about how index funds are traded. Unlike stocks or ETFs, you can't buy or sell them instantly during the day. They're priced only once per day after the market closes. This price is called the net asset value, calculated by dividing the total value of the fund's assets minus expenses by the number of shares. So it will be processed at the price calculated after the market closes, usually around 4 p.m. This is known as the cutoff time. Orders placed before the cutoff are processed that same day. Depending on the provider, processing can take a few days. This system keeps things simple, but it also means you don't control the exact price you get. For long-term investors, that's usually not a problem, but it's good to understand. So why are index funds so popular? Because they're low cost, easy to manage, and have historically performed well over time. Even investors like Warren Buffett recommend them, since consistently beating the market is very difficult. Now let's talk about mutual funds. At first, they may seem similar to index funds. Both collect money from many investors and spread it across multiple assets. The key difference is how they're managed. Mutual funds are typically actively managed. This means a professional manager selects investments in an attempt to outperform the market. The goal is to beat a benchmark like the S&P 500. While that sounds appealing, there's a downside: higher fees. Mutual fund fees usually range from 0.5% to 1.5% or more, and many don't consistently outperform the market. Still, some investors prefer them because they trust the manager or want exposure to specific areas. Large providers include Vanguard, Fidelity, and JP Morgan. Some mutual funds are active while others are passive, so it's important to check. Like index funds, mutual funds are also priced once per day after the market closes. Now let's move on to hedge funds. These are very different from the others. The term hedge refers to reducing risk, but in reality, hedge funds often take on more risk to it. They often use advanced strategies like short selling, leverage, and derivatives. These funds are actively managed and allow managers a lot of flexibility. This can lead to large gains but also significant losses. Because of the risks, hedge funds are usually only available to high net worth investors. They're also known for high fees, often following the 2 and 20 model. That means a 2% management fee plus 20% of profits. That's much higher than other funds, but the goal is to generate higher returns. Finally, let's look at ETFs, or exchange-traded funds. ETFs combine features of both stocks and index funds. Like index funds, they provide diversification across many assets. But like stocks, they can be traded throughout the day. This allows you to buy and sell in real time based on market conditions. ETFs also tend to have low fees, often lower than actively managed funds. Their expense ratios usually range from 0.03% to 0.75%. Most ETFs track an index, sector, or market. So if you want to invest in the S&P 500, you can do it through either an index fund or an ETF. Many ETFs can also be traded without commissions, making them very accessible. To sum it up, for most everyday investors, index funds or ETFs are often the best choice. They're simple, low cost, and offer strong diversification for long-term investing. Mutual funds may be useful if you believe in active management, but keep in mind the higher fees. Hedge funds are designed for wealthy investors willing to take on more risk for potentially higher returns. They're not usually suitable for the average person. That's everything I wanted to explain. I hope this helped you understand these investment types. If it did, I'd really appreciate it if you liked the video and subscribed. I'll leave another video here that you might find interesting.